So today we're going to talk about the second topic in our Retirement Base Camp program, which is specifically on retirement income planning and figuring out how much each of us will need. This is me. Happy to be joining you again today. And here is our agenda. We're going to discuss fine-tuning our retirement living expenses. If you were with us for the first presentation, which was really an overview, both Ron Fatula, the estate planning attorney, and I talked through a lot of the big decisions to be made as you approach retirement age. And now we're diving down into the actual mechanical steps. And one of the big ones is to really figure out what you'll need to be spending in retirement. Next, we're going to drill into the retirement income decisions and estimates, and this will be clearer as I go through those slides. Then I'm going to share with you some retirement income planning models. These are heuristic devices to help sort of frame how to think about retirement income planning. And then we will conclude with an overview of the Secure Act, which was passed in 2018 and had some significant impacts on retirement account distributions, something that we all need to be aware of as we make retirement income plans. Our picture, this is from our first presentation, showing all the happy people in retirement and these really wonderful activity-filled retirements that a lot of people fantasize about, and certainly that a lot of investment companies and insurance companies promote in their brochures. So the job is really left to us to figure out, well, what will I be doing when I retire, and how much will that cost? Where will I live? Who will I spend time with? How will I fill my days? And what sorts of activities and hobbies are meaningful to me once I stop working? So I'm going to point you back to the workbook that was sent out for the first presentation, and then if you were not with us for that one, was sent again in anticipation of this presentation. In it, on page 4, there is a form, and the intent is that you fill this out. This is the homework for the course, so that as you learn more about preparing for retirement, you complete this workbook, and by the end of the entire program, have a very, very good idea of where you stand relative to a financially secure retirement. So here you'll see the topic for this presentation, which is sources of income expected in retirement. And we have some sample lines. This is for you to fill in after you do some homework. I'm going to share with you what some of that homework is today. And then hopefully you did take a crack at filling out your current budget as at least a proxy for what your expenses are going to be once you stop working. If you are planning to retire in January, then the expenses you write down now are going to be pretty close to the mark in terms of what you should be budgeting for and how the cash flows will work beginning January 2nd. If you are 5 or more years away from retirement, well, this is really just a straw man. And as your retirement date comes closer, you're going to be able to figure out which of these types of expenses will be different once you stop collecting a full-time paycheck. It is helpful, however, to understand how to put together a retirement income plan, to actually use your current budget to figure this, to conduct this exercise. And I am not a financial planner who insists that everybody needs to keep a budget month in, month out, year in, year out. I think that's a level of tedium that most people just do not want to engage in and shut down if the suggestion is made. But at every critical juncture, anytime you are going through a transition from full-time to part-time employment, from going to school to starting a job, moving from one location to another, it is in your best interest to document your expenses. Because once you have those on paper, It's far more easy to notice things and to make accurate plans. So I would encourage you to use this opportunity during base camp to fill out this budget form and use it as we described. When we talk about retirement income, one of the first sources and most important sources for the majority of Americans is Social Security retirement benefits. And I would encourage everyone here on the call and any friends who are in your age group to either look at a recent biennial Social Security statement, which tells you two things: what your anticipated benefits are, but also captures your work and earnings history. And why it's important to look at that is that it's not a perfect system, and there are occasions when the record of earnings is not accurate. Now, I have biennial in quotation marks because most people have had the experience where it seems hit or miss that this thing actually shows up. It's supposed to happen after age 50 every 2 years. They suspended that for a period, then they brought it back, but it still seems kind of haphazard. Any of us can go on to the Social Security Administration site, ssa.gov, type that into your browser, don't Google it, to make sure you are on the government website. And you can, by entering in your personal information, register for an account and look up your income record. I will give you one warning. If you have a credit freeze in place, you will be prevented from doing this. So you have to lift your credit freeze with at least one of the agencies, credit bureaus. I believe specifically, the Social Security Administration uses TransUnion. Lift that freeze, open your account, print off your statement, and then you can drop the freeze back in place. It's important before you are ready to turn on your Social Security income that you really give a close look to your income record. There are periods that can be underreported for a number of reasons. For example, as a young person, this was certainly true when I got out of college, I held multiple jobs. I had a full-time job that paid peanuts, and I had a couple of part-time jobs that kind of helped pay the bills. All of those jobs took money out of my paychecks for Social Security. I was well under the income cap, and so all of that was retained. In my best interest to make sure that in those early years, if they're going to be included in the calculation of my eventual retirement benefit, that those numbers are right. If you had any periods of self-employment, this is where it gets tricky. And I will tell people, as I tell a lot of my self-employed entrepreneurial clients, it may feel really, really smart to owe no income taxes because you strategically have a lot of expenses that you deduct from your income and effectively don't owe anything to the IRS or state of New York. That's cool and that's great in the moment, but if you are not paying self-employment tax when you file your 1040, you are not getting any credit for those years of earnings. And so I've had conversations with people that, look, you gotta, take your foot off the expense pedal and start paying a little bit more in tax so that when you retire, you got something there. You've been self-employed for far too long. This is a significant and meaningful piece of what will be, these earning records are a significant piece of what will be your ultimate retirement benefit. Now, you may also have the situation where you worked for a company that now no longer exists. And then you have a bit of a research task with the help of Social Security, finding tax return information or them helping you figure out where to get the W-2 information for these defunct employers. Give yourself plenty of time before you're looking to turn on Social Security to do all of this cleanup so that it's not a big stressful, nightmarish task, right before you're expecting to turn on those checks. Basic information about Social Security. Most people are aware of this, but just in case, the way Social Security calculates our individual retirement income checks, they give us each credit, 4 qualifying credits per year, so 1 per calendar quarter, provided that you've earned at least $1,260 net in each of those quarters. It gives you this mysterious credit, or 4 credits. You have to have 40 credits, meaning that you've worked for 10 years total to qualify for any retirement benefit. Then when you go to collect your retirement benefit at your full retirement age, they use your highest 35 years of earnings to calculate that benefit. Now, here's the good and the bad of that. If you are someone, and this is true for many women who took time off to raise a family, take care of family members, parents, all of that, you might not get the full 35 years of earnings. And so consequently, your retirement benefit is likely to be on the low side. If you continue working past your 35 years, actually take that back. If you work past your full retirement age and you have earnings in those years that can take the place of any 0 years, that's what the Social Security Administration does and recalculates your retirement benefit. So, very much in your interest to take a look at the earnings record that you have, see if you have 35 years of earnings, if you can knock out any 0 years by continuing to work past your full retirement age, great. It could eliminate 0 years. It could also eliminate those years you spent scooping ice cream, earning practically nothing back when you were in college. So this too will ultimately increase your retirement income benefit. Now, how much should we expect Social Security to cover of our expenses, of our living expenses, once we stop earning a paycheck? Well, the average income replacement value is 37% of what we were earning, which means we were earning the average American income. If your income is lower than average, Social Security has a greater replacement value. If you had higher than average earnings, it has a less replacement value. It's a smaller percentage. For this reason, I encourage everybody to consider their Social Security benefit as a floor or minimum level of income in your retirement plan. For very few people does Social Security retirement benefits constitute an adequate income in retirement, all by itself. Here's a graph that shows in numbers and bars what I'm referring to. So here you see somebody who has low income, say $26,579. Based on that annual income, that full retirement age, their Social Security benefit would be $12,825. So that's almost a 50% benefit replacement value. If you had medium average earnings, you can see that it's more like 33%, roughly, maybe a little bit more, if your income had been $59,000. If you're in the higher earning brackets, you can see that this becomes much less of a replacement value for you. This is coming from the Center on Budget and Policy Priorities, and it's based on 2021 income averages and data. So it's fairly recent, and this is how we need to be thinking about Social Security retirement income. Next source of income in retirement that can be so important are pensions. And when I speak of a pension, I'm talking specifically about what's deemed a defined benefit plan, which means it is governed by ERISA, the Department of Labor, and it uses a formula that generally takes your years of service times your final average salary, does some fancy calculation, usually multiplication, maybe sometimes division, and gives you a specific income that you can expect to receive for the rest of your life once you retire. Now, this is distinct from a defined contribution plan. A defined contribution plan is a plan like a 401k plan or a 403b plan, which are plans to which we contribute out of our paychecks. Our employer may or may not match our contributions. So what we contribute defines what we will have when we go to take the money out. Obviously, if the employer is doing all the lifting with a defined benefit plan, and they are the ones basically guaranteeing that that number is going to be the same, that check you get every month is going to be the same so long as you shall live, they assume that risk. They're the guarantors. In a defined contribution plan, there is no guarantee. And it is on us to invest well, treat it properly. But what we get out of that account will be based on how much we contributed and our method of making withdrawals. Now, what can sometimes be confusing to people is that retirement plans in general are governed by what's called a summary plan description. Defined benefit plans, traditional pension plans have these, but so do these defined contribution plans, your 403b and 401k plan. All it is think of it as a prospectus for a retirement type of plan. And by law, they have to produce this every year, update it with information about the results of the plan and all of the rules and regulations, stipulations that govern how people put money in and get money out of these different types of plans. The vesting schedule is important to know for the defined benefit plan. When do you qualify? According to the summary plan description, and you have earned a vested pension benefit. Vesting schedule also applies to any matching contributions from your employer in a defined contribution plan. The vesting schedule will be explicitly stated in the summary plan description. And we went over this in the last presentation, but you'll remember that there were things like 3-year cliff vesting, 5-year percentage vesting. But once you pass that vesting schedule, you're in like Flynn, and you can count on this, it's now owed to you. For the defined contribution plan, once you are fully vested, it means that all the matching dollars previously and going forward belong to you. That if you were to leave, you could roll it out with your other money, with your contributions. So with both of these types of plans, you have options at retirement or before retirement. And when I say you have options before retirement, if you were to leave your employer, both these types of plans have provisions for you to roll over that balance into another retirement investment type account. So that can make sense for a pension if you are young and leaving it behind. It's sometimes better to leave the pension on account and come back to it if you don't have decades ahead of you before you're going to turn that income on. That's very much an individual decision, an individual calculation. So there's no blanket recommendation as far as that is concerned. At retirement, you can turn on your pension right away. You can delay it with your 401k or 403b plan. You can take money out of it immediately, or you can just leave it for a later time. So these types of options are also spelled out in the summary plan description brochure. And typically these are now, they used to always be mailed to you. As a participant in the plan, you would get the summary plan description every year. And it would talk, if you were in a pension plan, about how well funded the plan is, how much money came out, how much money was contributed, whether they met their assumed rates of return, etc. Now it's more likely that you will get a PDF online or be directed to the website by the administrator to find this summary plan description. Do know that many people, in an irritating fashion, refer to this as the SPD, which is very confusing. That stands for summary plan description. It's jargon that people in the business use, SPD, but that's what this document is. And it's an important document to know. Now, what if you left a pension at a former employer? And I work with people of every different age. And so I know a lot of people who vested in a pension, either after 5 or 10 years of employment, whether with the city or the state or a company that offered a pension. And many of these folks assumed that that pension was, lost to the ages because they moved on. Not so. I mentioned before that pensions are regulated by the Department of Labor and the IRS. There is an incredible amount of scrutiny, and there are not a lot of shenanigans in this area of retirement finances. So this money is findable. It is even findable at defunct employers. So if you worked for a company, and I'll use the airlines as a good example, where your employer got merged out of existence and they froze the pension and then, poof, it's gone. Not necessarily. There is something called the Pension Benefit Guarantee Corporation. And what their role is to basically babysit these pension records until the people who were employed pre-merger or, Chapter 11, whatever it was, come forward, are of age to turn on these pensions, and they will hook you up with these benefits. You prove that they have your information. They know that you are likely to reach out to them, but you may not know that these are available. This is a website that helps people find those benefits. You can also search the database at the Pension Benefit Guarantee Corporation. So whether it was a state pension or an industry pension, there are ways to track this stuff down. I recently worked with a couple that were unaware of 2 pensions that the husband was eligible for. It made a huge difference. The first one was with a defunct company, so it didn't amount to a lot of money, but because it was a defunct pension, they had the option to take a lump sum, and it made financial sense for them to do so. And then with the second pension, it made sense for them to take the ongoing monthly benefit. So there may be money out there for you. Don't give up on these old promised pensions. How much will your pension cover? Now, if you are currently working for an employer that offers a pension, many of these entities have an online estimator, information about the pension, how the formula works. Sometimes there's a PDF of a brochure explaining all of this. Sometimes what they do is encourage you to contact the pension benefit administrator and either make a telephone or in-person appointment to learn more about the pensions. Worked with a lot of teachers. I've worked with members of the police force, firemen. All of them have pensions, and every one of them is different. So you can't assume that they all work exactly alike. Some have great support in terms of being able to call and get great information emailed to you. Some, it's a bit of a paper chase. Like a lot of teachers, it's hard for them to get an actual appointment unless you are within a few years of actually retiring and turning this thing on. But it's good to know, at least in round numbers, if you are 5 to 10 years out, what that annual income is going to be. It's hard to plan without knowing what those numbers are. So there's an awful lot of terminology that's going to be thrown at you when you start talking to your pension administrator. So I want you to be familiar with some of these terms and to really press them to explain very clearly or give you great documentation on how your pension actually works. I mentioned the summary plan description. If you've ever read an investment prospectus because you bought a mutual fund or an exchange traded fund, You know that prospectuses are, even though they are technically written in plain English, they can be pretty hard to get your head around. The summary plan description is similar legalese. So often what they do is the pension system will put together a brochure. Some of the best brochures are for New York City teachers, because as you are probably aware, if you know any teachers, depending on when you became a teacher, you joined different tiers of the pension system. So there's still people alive today who joined tier 3. There are a lot of people in tier 4. More recent people who joined as a teacher, administrator, or employee of the DOE are in tier 6. The tier determines how juicy and generous the pension is. So what you're going to look at in your document for your tier is what is the formula for calculating your actual pension. It's going to be some calculation, years of service, final average salary, and a percentage. So normally the way it works is there is a way that they figure out final average salary, what's included, what's excluded, how many years are considered. There's a multiplier that creates a number. That number is roughly the annual pension you can expect. When they multiply that by years of service, and it goes up and down. Some of these formulas have a lot of moving parts. So you have to look specifically at how your pension works. Now, because this can be so complicated, every pension administrator has the ability to give you a hypothetical illustration of your monthly benefit. This is going to be dependent not only on the formula for calculating it, but how you elect to have your pension paid out. If you are a single person with no significant other to whom you want to leave part of this pension, no spouse, no partner, you would elect a life-only pension, and this would give you the highest possible monthly payout. If you wish to ensure that your spouse or partner received at least half your pension, you would take a lower monthly amount, but know that God forbid something happens to you, half of that ongoing payment would continue to your spouse or partner for as long as they should live. Some allow a 75% spouse or partner benefit. Obviously, if you're looking to guarantee 75%, your regular monthly check is going to be a bit lower. Another thing that some pensions do is give you what's called a period certain. This means you get a high monthly payment. Now, there's a little bit of a haircut, and that is guaranteed for, say, the first 10 years. And if you were to pass away in those first 10 years, there is a lump sum payout for the rest of that pension, for the rest of those 10 years, that goes to your spouse, partner, beneficiary. So that can be a way for certain individuals to manage, how do I make sure this income continues or something is left to my family or beneficiaries. Another provision, I've seen this in teacher pensions, is what's called a pop-up. And a pop-up allows the employee to pick the spousal rate. Maybe that's a 75 spousal rate. So they start out, they've got a lower pension than they would have gotten if they had chosen life only. But if their spouse or partner passes away, their pension amount pops up close to what the life only amount is. So that can be a good hedge. For example, you have a husband and wife. The wife may be younger, but may have some health issues. He does not want to leave her without money if he gets hit by a bus, but he is concerned that there's a good chance she may predecease him and he would have a permanently lower pension, which would get harder as he got older. The pop-up provision is, helps you plan for that scenario. When you have the conversation with the administrator, have them explain what the different options mean. The paperwork looks great. Get it in writing, give it to your financial advisor so they can walk through it with you and explain what the various options are. Once you sign up, however you elect to take the money, you will make an irrevocable election. You can't go back next year and say, you know what? Don't want to leave leave 50% to my spouse. I want the life only. Now you do this once, so you have to do it right. Quick comments on the Veterans Administration. I bring this up because people overlook this as a source of both income and benefits in older life. I have a client who only recently realized that her now long deceased husband, who had been a vet, eons ago, Korean War, was eligible for a pension. She found out about it from a girlfriend because her husband was eligible. So she is now getting this, albeit modest, but for her important additional source of income. Additionally, if for many former service people, if they were active, there was a life insurance death benefit. My father was eligible for this. It's not a huge amount of money, but most people don't know about it until they contact the VA and send in the paperwork to claim it. The other benefit, if you have served, and I know many people who served, whether active or through the National Guard, if you are able to retire from the military with the right number of years of service, active and then in the reserves, you could get yourself a VA hospital card. And my father-in-law is a good example. He served in the Marines. He was active and then served in the National Guard for a number of years. And he now toggles between the VA hospital for certain care and his Medicare paid doctors. He likes the heart specialists at the VA hospital. And as you've probably been keeping up with the news, you know that they have spent a lot of money really, really improving the orthopedic care. So if you need that kind of therapy or rehab, that may be the better place to get any orthopedic surgery. And having that card and going through the registration process may be in your best interest. The other thing that I have a classmate from NYU undergrad who stayed in the National Guard after serving in Iraq. He just got his VA ID and just loves the benefits that come with that, as well as the pension. He shops at the commissary, he uses the travel benefits, and there are some discounts that are given to former vets. And lastly, if you served in the military, you are eligible to be interred and in fact given a burial in a VA cemetery. I believe every state has one. And in fact, my father and mother are buried in the VA cemetery in New Jersey. It's beautiful. The services are really well done. And this is free for veterans in appreciation of their service. Other employer-provided retiree benefits that should not be overlooked. Retiree medical benefits. Now, often what happens, and these are becoming scarce because medicine in this country is so expensive, but often what happens is if you are retirement age, you are on, because you're over age 65, you're on Medicare, but your former employer basically gives you your supplemental insurance. So a lot of universities have done this, and a lot of other companies have had this. It's beginning to get phased out again because the cost of medical insurance in this country are so high. Other things that are pretty great is that with a retired employee corporate ID, you can enter museums, you can have event access. There are travel programs for the alumni of many Fortune 500 companies, real enrichment stuff. It's really kind of interesting to see. And the one that I like as a financial planner, particularly if you have been in a guild or a union, you may have access to a dedicated credit union that offers really advantageous financial products. So for example, you may have access to credit cards at lower than typical rates, free. You may be able to get a HELOC, with much less hassle because you are a member of this guild and of this credit union. I meet a lot of people in unions who never really dig into the many different benefits that are available to them. I love studying this stuff, and I think that more people should, because even as retirees, there are really great things that can save you a lot of money available to you. All right, so after we've dug through our guaranteed sources of income, we are going to factor in income that might come from other sources. Maybe you are fortunate and receive income from some family trust, or you get royalty income, you wrote a book or sold some art. Maybe you have an annuity and you're either taking withdrawals or you have annuitized it and received regular payments. This is part of your retirement income plan. If you own some rental properties, this too can be a nice, fairly consistent source of income in retirement. If you're planning to work part-time or freelance, once you stop earning a full-time job paycheck, that can be a good source of income. And really looking at all those sources of income, you can figure out how long you may want to continue even this part-time work. Many people are in a position to know that they are going to receive either consistent or one-time financial gifts, typically from relatives, or inheritances from parents or other relatives. This can be a significant part of somebody's retirement income eventually. And then lastly, if you are the beneficiary of a life insurance policy, and your mother has one, your aunt has one, you're the beneficiary, this too can be a significant source of money that can be spent in retirement. Now, the test, after you've documented all of your expenses and then all of your sources of income, is how well does this income cover your monthly and annual expenses? And I want to just walk through this with you as sort of a framing device. Okay, so what I want to introduce is the idea of a flooring strategy. A minimum amount of income, how much will that cover for us? And for flooring, we're talking about guaranteed income, money from Social Security, money from a pension, money maybe from these income properties. If the income you receive fully covers your retirement living expenses, not a care in the world, you've got a robust floor, and you will be much less reliant on your investments to cover your expenses in retirement. Most people are really over here, all right, because there aren't that many people covered by pensions anymore. And we'd all like to have a trust kicking out income, but not a lot of people do. So most people will have some income, maybe a modest pension from a job earlier in their career. They'll have Social Security, and they'll have a 401k or 403b that they will have to draw down over time to cover their expenses. So they're in the medium camp. Some people, and I would put most self-employed people here, no pension because you've been working for yourself. Your Social Security, depending on how you played the business expense game as you did your taxes over the years. Hopefully you've put a lot of money away and you have assets that you can now plan to draw down. But you will have a minimum floor, and floor simply stands for that guaranteed income to cover your ongoing retirement expenses. So now what I'd like to do, and again, these are heuristic devices, rubrics maybe, to show you how to frame and think about a retirement plan. This one, the liability matching approach, was actually devised by Fidelity in the early 2000s. Fidelity, obviously one of the largest investment management companies on the planet. Fabulous job helping people accumulate assets, helping people invest for the future, for their goals, including retirement. realized at that time, hey, all these people are going to retire and they're going to spend down all this money. How do we help advise them? So they actually created a retirement income institute and had a lot of people working on this problem. How do we guide people in spending down their accumulated assets in retirement? So the very simplest first concept they came up with was this liability matching approach, where you simply deck your guaranteed income against your essential expenses. So, we think about our essential expenses: housing, food, utilities, medical care, insurance. There might be one other thing that would be essential to, keeping the operation running month to month. If our guaranteed income covers these, we are in very good shape, right? And that lets us use our non-guaranteed income, so money coming out of our 401k, our IRA, our investments and our savings, for discretionary expenses. So again, back to that picture of all those retired people having fun playing golf or out on the beach. The discretionary expenses might include golfing trips, vacation, cruises, big new wardrobe upgrades, renovating the kitchen, whatever it is. You have some discretion. So in a down market year, maybe you put off the expensive cruise, you vacation more modestly, and you put off these renovations you'd like to make to your kitchen. Market goes back up, those are back on the table and you can take the money out. And again, what this protects you against is withdrawing too quickly from these accounts that are subject to market risk. Because if you take money out when your investments are down, you increase the risk that you will run out of money, that you will take it out too quickly. So this is the liability matching approach. Another approach, which has really been made famous by Christine Benz at Charles Schwab. If you follow her, actually she's not at, she's at Morningstar, forgive me. She has at least a quarterly update that she does, a newsletter she puts out following the 3-bucket approach to retirement. And she goes over the investments that should be held in each bucket. And she talks about, well, how well did they do? And she makes different recommendations. And again, this is a thinking device to help people, because the prospect of not getting a paycheck that helps you pay your bills every month and having to withdraw money out of investment accounts to pay your bills makes a lot of people freeze. And so organizing it in our minds that we have 3 buckets, that we keep 1 to 2 years of essential expenses in cash, held for yield in the bank, whether in bank CDs or treasury bills. This is helpful, right? We have in the interim years, so a duration of 3 to 9 years, income or interest producing holdings, including bonds, real estate investment trusts, deferred annuities. The idea of these is that they're not super volatile. They generate some yield, and that acts like a spigot, and that yield is dumped over and refills our cash bucket. This lets us keep our equity investments without worrying about them. These are investments we're going to hold for 10 or more years. And the way, when I'm working with clients, that I talk to people about this, let's not think about the accounts in which these investments are held. Some of them are going to be in retirement accounts, some of them are going to be in taxable brokerage accounts, direct mutual funds, whatever it is. But the equity bucket, we want to make sure we'd be comfortable holding this stuff for 10 years and not worrying about a down year like 2022. I mean, we're down about 22% right now. May come back, may not, may stay flat, may go down further. Nobody knows for sure. But if you're set up in this framework, you know you got money in the bank to pay your bills. You know your cash bucket will be refilled slowly, and that when the money comes back, or the market comes back rather, when it goes up, you can harvest some of these gains. move them over here. So the money grows, gets harvested, and moves from bucket to bucket. So this is very helpful for a lot of people to just get used to the idea of living off a portfolio and not a regular paycheck. There are two more approaches to retirement income planning. I'm going to go over these both fairly quickly. The 4% withdrawal approach was all the rage in the early 2000s. This was, pursued by academics in finance who figured out by doing back tests on market conditions going back to the Great Depression that retirees could take 4% of your total invested assets out of the account every year and be fine, not run out of money. And so this was based on long-term market return and volatility stats. If you were in 2004, this looked pretty smart. Same thing, assumptions for long-term average interest rate. We had seen inflation come down dramatically over the decades, so that seemed, like it would continue forever as well. And it was also based on average assumed longevity. And this might have been the biggest kicker. But we all know what happened. The great financial crisis of 2008, 2009 blew this up. I mean, this went kaplooey. It was not anticipated that stocks and bonds would go down as dramatic at the same time as dramatically as they did, that things would stay volatile for 18 months and kind of throw this 4% withdrawal approach into, kind of a dangerous scheme. The other thing that people realized starting at that time is that people were living longer than the model assumed. If you're living to 100, this 4% is not going to get you there. It is fairly common given average assets. And if you start with millions of dollars, then you're probably fine, but most people aren't. And if you have an average portfolio across all of your different accounts and you happen to live to 100, 4% would be a bit of a challenge. So the new study, and this, again, lots of finance professors and people, back testing and really putting this through its paces. If you take a flexible approach and you base your percentage withdrawal on the prior year-end balance. So last year, market went up. You would have had a nice big check coming out of your accounts in January of this year. This year, you'd be saying, might be a little thin for next year's withdrawal, might be taking less out. So what this allows you to do is put less strain on your accounts by taking less out after a market decline. It allows you, if your returns continue to go up and up and up, and remember, we recently ended a 12 plus year bull market. There were people who could have been increasing their withdrawal rate over that time because returns were great and inflation was modest. To prevent having to take too much out, you keep a large cash balance, sort of as a cushion for the years that are going to be a little thin when that check comes in on January. But the other benefit that these researchers are now looking at is that not only does this manage the risk of overspending, meaning taking too much out when your account is down, it also reduces the risk of underspending. Because if the market goes up, year after year after year, you can take more out of it, out of your accounts. You're just, doesn't have to all be left for your beneficiary. You don't have to live on such a tight budget. You can spend this money and enjoy it. It's yours. The other neat thing about this approach is that with your base year, the year you start this, not only do you start with a percentage, you get a dollar figure. And most people don't think in percentages, they think in dollars. So that becomes your base paycheck. So if in the next year you have to reduce your withdrawal amount, your advisor could say, hey, next year, if the market goes down 10%, we're going to do a similar reduction in your January paycheck. You'll get that. That will be easier for you and your advisor to talk about so that it does, this Discussion of percentage rates is kind of anxiety provoking. Discussions of dollar amounts can be a lot easier to understand. So we're going to turn now to the Secure Act. But before we do that, I just want to remind you, and this is the next time I speak to you, December 1st, we're going to have a whole presentation on income tax. Very important thing to know about as you go into retirement, because you have fewer places to hide from the IRS. But we're going to go over this quickly because it's material to the Secure Act. Bank savings are taxed, your interest is taxed. Your money that goes into most savings account and checking account is your money after tax from your earnings. So only your interest is taxed. Brokerage, taxable brokerage account, dividends that you receive, you may have qualified dividends, which means that you've held a stock or fund for more than a year. Those get capital gains tax rates, but regular dividends get taxed like regular earned income. If you sell an asset in your taxable brokerage account within the year that you bought it, any gain is taxed at income tax rates. If you've held that asset for more than a year, you get those beneficial capital gains tax rates. And again, we'll get into this with some level of detail in December. Your 401k, 403b, 457b, and individual traditional IRA, when you take any money out of those accounts, it's taxed at regular income tax rates. Your Roth IRA, you put after-tax money into it, you take tax-free money out of it. If you've had the Roth IRA account for 5 years and you're over age 59 and a half when you make that withdrawal. Prior to age 59 and a half, you can take your own money out, meaning your contributions, but you can't take your earnings out without a tax penalty. All right, just sort of previewing what we'll be talking about next time. The tax profile of accounts should influence the sequence of drawdowns. What am I saying here? Well, for most people, it makes sense financially to delay your withdrawals from your tax deferred accounts. Spend your taxable stuff early on in retirement for two reasons. You keep your tax bill low, and by not having to take extra money out to pay the income tax, the 10% withholding or whatever your rate is, you allow that money to grow and compound. This can actually improve the longevity of that portfolio, help your money last in retirement. All right, now let's get into the impact of the Secure Act. Passed in 2018, went into effect in 2019. It moved the date when each of us has to begin required minimum distributions, withdrawals from retirement type accounts to age 72. There are still people who were 70 and a half when this law went into effect. They continued the RMD schedule they were on, but it delayed the start of these mandatory withdrawals for a large segment of the population. In 2021, because this was done to acknowledge the fact people are living longer, they actually updated the IRS universal life expectancy table so that the percentages that you take out starting at 72 are a little bit lower. And this all, this impacts all of these types of retirement accounts. Now, a special word about people who are contributing to Roth 401k or 403b accounts. These are wonderful vehicles. They let you put after-tax money into these retirement accounts, grows tax-free. However, 401k and 403b plans, the money in these, regardless how they're invested, are subject to the rules on 401k and 403b plans, which means that even if you have money on the Roth side, that money will be subject to an RMD at age 72. To avoid that, you have to roll over the Roth segment of your 401k or 401k or 403b into a standalone Roth IRA. Then you have no RMDs. But if you don't do that, they're going to calculate the Roth portion in your RMD required withdrawal. There are very stiff IRS penalties for missing an RMD distribution. This is why, if you are of this age, you get a reminder in January. They send you a mailing in July 1 after the half year, and they really start to, tap dance on you as the year goes on if you haven't made this withdrawal. The penalty is 50% of the amount that you are required to take out. So imagine your RMD amount was $40,000, and for some reason, and it happens, you flaked and you never did it. December 31 goes by, withdrawal never happened, you can't win an appeal, there was no real excuse. You would have a $20,000 penalty that you'd have to pay to the IRS. So that's why there's a lot of over communication about this from your retirement plan administrators. All right, now, background on the Secure Act, driven by increases in longevity since Social Security Act was passed in 1935, reflects the fact that an increasing number of Americans work to age 70 and beyond. So right now that's 34%. It's actually ticked up through the pandemic with flexible work arrangements and work from home. It also reflects the disappearance of defined benefit plans. There are no guarantees. And the fact that we do have a retirement savings crisis, given that there are underfunded defined contribution plans, people aren't putting enough aside, or they work for companies that don't offer plans and have not on their own contributed to IRAs and other types of investments. So there was a recognition that forcing people who really wanted to make their retirement money last by deferring required minimum distributions further, forcing these distributions because you have to pay tax on this money only made this retirement security problem worse. So for all of these reasons, the Secure Act was passed. And there are some enhancements coming to it. If they're still in negotiation, probably still in committee, and we will see if this comes to pass. But the plan so far is that, yes, certain employers would have automatic enrollment into their 401k and 403b plans. Informally, this is happening now with a lot of employers, but not everybody. The RMD age would go up a year in 2023. So we have that to look forward to. If you're not yet 73, this is your new date. Then 2030, if you're not yet 73, your retirement age, RMD age, goes to 74, and ultimately it goes to 75. And again, this is to help people not be forced to withdraw this money too fast, because there are an awful lot of seniors who have to take the money out, but then they don't spend it. Then they have to invest, pay taxes on it and reinvest it in a taxable account and hope that it kind of, continues to grow and grow back. So hopefully this improves the retirement readiness of many Americans. So in summary, we're at the end. Work on identifying living expenses in retirement. Good guesstimate at this point, an approximation helpful to work through. Track down your sources of expected retirement. This can be a bit of a paper chase, but start early so that it's less stressful. Give yourself plenty of time. Do your workbook financial inventory, very important. Think about the retirement income models, which would work for you, which kind of helps simplify this process, and which don't. And then figure out when you'll be subject to RMD withdrawals based on your current age. Lastly, I'm going to leave this with you. I'll go through it quickly. There's some terms on here, QLAC over here, qualified life annuity. We're going to talk about that during the tax presentation. But this, you're going to see this over and over again. By the time you're done with this program, you'll get this. You'll have the timeline. You'll know what you need to do. But it outlines a lot of the information that we have presented in the first presentation in terms of when you need to make certain decisions, and and some coming decisions, that impact taxes. So it talks about earliest possible claiming age is 62, 65 is traditional for a lot of people, depending on the year of your birth. And then it goes up. Remember, you have to sign up for Medicare Part A. If you wanted to talk about long-term care insurance, this is a separate section. We'll have a whole presentation on this. You need to make that decision before or by age 65. If you wait to 67, for most people, that's 100% of your retirement Social Security benefit, but you get 8% a year if you wait until 70. 70 and a half, some people subject to RMDs because of where their birth date fell. Remember my warning about Roth 401k and 403bs being subject to RMDs unless you roll them to a standalone Roth. And if you're still working, you don't have to do RMDs because you're contributing to those accounts. And then at 75, we'll talk about this next time. I'll explain exactly what a QLAC is and why it might be beneficial for certain people. So now I'd like to handle some questions.
Okay, there are quite a few. I'm going to start from the very first one, going back to 1:18 p.m. If I have generally mid to low earnings most of my working life, but then I sold 2 assets in 2 different years, these 2 years were very high in income on my tax return. Am I understanding correctly that these 2 high years of reported income should significantly lift the average of my 30 years of work life? Thank you.
Yes, if all of that gain from the sale of those assets flowed through your tax return and you paid taxes on that, then yes, you're going to see that reflected in your Social Security statement. And if it isn't, then you should have time to go back and get that corrected.
Great. What if we want a pension balance to go to our children?
Some pensions permit that. You don't have to be related to the person, so that's why partners are included, and some permit children. There are some limitations, obviously, because pension plans don't want to create a perpetuity. That's not how they're designed and funded, but there can be an opportunity to leave them something.
Okay.
You have to look at the summary plan description.
If I don't have any natural membership to a credit union, is there a way I can research credit unions that I might be able to join in New York City?
Yes. And you're not restricted to New York City. There are national credit unions that you could join in other states. There are great articles that are published every year. NerdWallet, which is a personal finance blog, they do a survey every year of the best credit unions. Money Magazine, which is now online, they too do special editions on best credit unions for the year, as well as best bank rates, that sort of thing. So I would definitely do online research and find it through some of those personal finance blogs.
Okay, I inherited my husband's 401k from Verizon and assumed the SEP he had from self-employment. I have a pension which will cover needs. I will have to begin to pull from both in 2022-23, but don't need or want to at this point. Would I be better off to take the hit and convert some to a Roth so that I can pull later with no tax impact?
That may make sense for you if you are currently in a low tax year. A Roth conversion strategy where you take some of that money out, convert it, roll it from the traditional IRA to a Roth, pay income tax on it now. This will reduce your RMDs going forward. The other strategy is one that we'll talk about in December, which is that qualified life annuity contract. So you've got a couple of options. But yes, you have a tax whammy coming at you.
Okay, the flexible withdrawal approach. How do you know what percentage to pull each year? If you don't adjust the rate annually, there is no conceptual difference between the 4% and the flexible withdrawal approaches.
So I probably should have used an example to show it in dollars and percentages between an up year in the market and the down year. You might start at 4%, and then because it's a market drop of 25%, you decide to reduce next year's withdrawal to 3% or 2.5%. So this would show you what you're trying to do is target a certain amount of income. So your 4% equals, say, $30,000. We call that your annual income, but if the market drops by 25%, we're going to cut that by 20%. So 20% of 30. So that's how you calculate that. You just want to be in a position where when your investments are lower in value, you're taking a lower amount out. I
Great.
hope that explained it.
How do I access the monthly reports of the Morningstar lady? What is her last name?
Benz, B-E-N-Z, Christine Benz. If you Google her, she is all over social media. You can find her stuff on Twitter. There are probably other outlets where she publishes this. And I don't believe that her publications specifically are behind their paywall. So I think you can get her 3-bucket reports for free.
Okay, to be clear, if I have a standalone Roth, I do not have to take RMDs?
Correct.
That was easy. Do Social Security amounts increase every month that you wait to file, or only once or twice a year?
Every month. It goes up by just a little bit. And if you either go into the Social Security website, or if you look on your biennial statement, you can find information about, that little bit. It's a consistent percentage that it goes up each month. So if you don't make it all the way to 70, maybe you get to 69 and 2 months, and you're like, man, I need that check. I need that to start tomorrow. You've still done yourself a great favor. It's bigger than if you had taken it at, say, age 67.
Okay, thank you so much, Anthea. Thank all of you for your thoughtful questions, for your time and attention. You will be receiving the slides at the end of the webinar, which is now, but later in the day, maybe in the morning. And also, you'll be receiving a survey to give us some more feedback about how we can make this better. You can get access to upcoming courses at pssusa.org/retire-ready. And we really look forward to seeing you on November 17th with Ron Fatula for putting your trust in living trusts. So once again, thanks so much, Anthea.
Thank you. Bye-bye.
Have a great afternoon.